All right, so I'm listening to a book on tape called The Skyscraper Curse by Mark Thornton. So I read this book in the morning when I'm taking Pop, which is the the Holy Grail of macroeconomics. When I'm taking Pablo for a walk, I listen to The Skyscraper Curse by Mark Thornton. At least that's what I'm doing right now. I actually listen a whole lot quicker than I read, because when I read, I got to sit there and think and take notes and do some research. The drawback about listening is that you listen in your car and stuff, so it doesn't give you the same ample opportunity to do the research on various things you heard. It's a pretty good book. I highly recommend you get it for sure. The book is called The Skyscraper Curse, and How Austrian Economists Predicted Every Major Economic Crisis of the Last Century. Anyway, so I want to chat on something because I never heard of Mark Thornton, at least I'm aware of. Let's just read real quick the description of it. The Skyscraper Curse is Dr. Thornton's definitive work on booms and busts and explains why only Austrian economists really understand them. It makes business cycle theory accessible to a whole new 21st century audience. And they need it, especially those under 40, because those under 40s aren't being taught anything. Many of the brilliant quants working on Wall Street and the Fed barely remember the crash of 2008, much less understand it. But Mark Thornton does, and his book is a warning about overheated equity markets, overinflated housing prices, and clueless central bankers. And given the shaky stock market returns lately, 2018 may be the year in which the Fed's bubble bursts, which obviously did not. And when it does, it'll be even more painful now than 10 years ago. In fact, U.S. household and business debt is now $1 trillion higher than 2008. Let's see. He was one of the only handful of economists to warn about the dangerous housing bubble in 2004 and then again in 2006. Cabbies and waiters bought up condos with no money down in a place like Las Vegas. Okay, we've heard all this before. All right, so that's good. But it's an interesting, because there's I don't frankly care about the Skyscraper Curse. I mean, you can make anything seem like it was predictive. I don't care. But I do find it interesting, the history, the economic history of pre-Federal Reserve Board and post-Federal Reserve Board. Is very, very interesting. Very interesting. And then I'm telling you, you've got to well, you don't have to, but it's interesting to understand the booms and busts pre-Fed, and then to understand the booms and busts post-Fed. And then you got to think what he says goes back to it is the banking regulations of 1863 and 1865. I find that incredibly interesting. So I'm going to read some up on that when I'm done listening to this. But anyway, so he talks about this guy named Richard Roll, who's an economist at, I think, Caltech or something like that. And I had never heard of Richard Roll, so let's click on Richard Roll here. Let's see. As an American economist, best known for his work on portfolio theory and asset pricing, both theoretical and empirical. He's got his bachelor's degree in aeronautic engineering from Auburn, MBA, PhD from University of Chicago in economics, finance, and statistics. His PhD thesis, The Behavior of Interest Rates and Application of the Efficient Market Model to the U.S. Treasury Bills, won the Irving Fisher Prize as the best American dissertation in economics in 1968. He co-authored the first event study that sought to analyze how stock prices respond to an event in 1969 using price data from the newly available CRSP database, and he's co-authored papers with Stephen Ross, Fama, Jensen, and Kenneth French. All these guys are well known. He published over 80 articles. So he's a well-credentialed guy. But one of the quotes he said, which I thought was interesting, that my man Thornton attributes to him, is he tried all the different, the end of the year, all the different arbitrage theories, or I don't know what's no, you can't do that, buddy. No, I'm gonna have to spray some stuff on there. He keeps trying to chew my leather. Negative. So, Dr. Roll, come here. He's done all the different theories, like the buy, sell in May, go away, or whatever it is. The October surprise. In terms of the end of the year theories, all these different theories, dogs of doubt. He said he's tried all of them, and none of them work. Even though they seem good on paper, they don't work in reality. I thought that was pretty interesting. And and you should look up this guy and read some of his stuff, because I found that incredibly interesting. He goes, look, I tried all the arbitrage, all the thesis, all the theoretical stuff. I used it. None of it worked. None of it worked to make me a dime for me or my clients. But he has this thing. It's called the Roll critique. Rawls critique. And this is, oh man, do I say incredibly interesting enough? Yes, I think I don't. I think I need to save it more. Rawls critique is a famous analysis of the validity of empirical tests of the capital asset pricing model. It concerns the CAPM. It concerns methods to formally test the statement of the CAPM, the equation. The equation relates the asset expected return to the asset correlation. Yeah, I see you, buddy. He's looking at me. Expected return to the asset correlation with the market portfolio return. The market return is defined as the wealth-weighted sum of all investment returns in the economy. So think about that. The market return, expected market return, is going to be defined as the wealth-weighted sum of all investment returns in the economy. Rawls' critique makes two statements regarding the market portfolio. Mean variance tautology. Any mean variance efficient portfolio satisfies the CAPM exactly. A portfolio is mean variance efficient if there's no portfolio that has a higher return and lower risk than that of the efficient portfolio. So it's mean satisfied. It satisfies the mean variance efficiency that there's no portfolio that has a higher return with lower risk. That is a most efficient portfolio, and thus it's mean variance efficient. Mean variance efficiency of the market portfolio is the equivalent to the CAPM capitalized asset pricing model equation holding. The statement is a mathematical fact. It requires no model assumptions. Given a proxy for a market portfolio, testing the CAPM equation is equivalent to testing mean variance efficiency of the portfolio. The CAPM, capital asset pricing model, is tautological if the market is assumed to be mean variance efficient. So what does all that mean? You have to have for the CAPM to work, capital asset pricing model, you have to have a portfolio design, a market portfolio that cannot be beaten with less risk. Now, again, that is the market return. What is the market portfolio? What is the market? The market return is defined as the wealth-weighted sum of all investment returns in the economy. All right, let's keep going down to statement number 2. So you have the wealth-weighted returns of all the investments weighted. The market return is defined as the wealth-weighted sum of all investment returns in the economy. If you have that, and you have no greater return with less risk, then you have a market means variance efficiency, which would satisfy capital asset pricing model. Of all investment returns in the economy. So now let's go to part 2. The market portfolio is unobservable. The market portfolio in practice would necessarily include every single possible asset available, including real estate, precious metals, stamp collections, jewelry, and anything with any net worth, my baseball card collection. The returns on all possible investment opportunities are unobservable. So from statement 1, the validity of the CAPM is equivalent to the market being mean variance efficient with respect to all investment opportunities. Without observing all investment opportunities, it is impossible to test whether the portfolio, the market return, is indeed mean variance efficient. Consequently, it is not possible to test the capital asset pricing model. And yet that's what all these guys use. Hey, that's what they all use in their business school, in their future returns on portfolios. All the different theories is based on capital asset pricing model. But how do you test that to get mean variance efficiency? It's impossible because you have to test literally. You have to observe real estate, baseball card collection, precious metals, stamp collections, jewelry, anything with any worth to see if it gives you the greatest return for the lowest level of risk. Nope, I catch it, big man. It's impossible to do that. So consequently, because you can't observe all the possible investments out there in one fell swoop and say have they given the max return for the lowest amount of risk, it's impossible to test the validity of the CAPM. The means variance tautology argument applies to arbitrage pricing theory and all asset pricing models of the form. All right, so anyway, discussion. Rawls' critique has received a large number of citations in the financial economics literature. The majority of these, though, refer only to the second statement of the critique. Few papers address the first statement. Many researchers and practitioners interpret Rawls' critique as stating only that the market portfolio is unobservable. That's true, but it's unobservable. Why? Because you have to say you have to get the highest level of return for the lowest level of risk, and it's impossible to say that. So Anyway, I don't even know. I find it incredibly. So again, the whole point about reading, listening, watching, observing is to get. This is why I love economics. It's just because it's not blinded by. The only thing it's blinded by is globalization. It loves globalization, the theory behind free trade, free markets, free labor, and all that, which is good in a way. But they were able to. After the stagflation of the 70s, Keynes got his come up. And so, look, John Maynard Keynes was a wonderful investor for sure. I'm sure he was, actually, I don't know. I imagine he was a good man. I don't know that to be true. Seems like I've read someplace that he was a good guy. He could argue with him. I forgot who read it, maybe Hayek or so. I don't know. But anyway, he was a wonderful investor for sure. All right, but that wonderful investor does not make your economic theory right. It doesn't. So anyway, everyone, including Nixon, we're all Keynesians now. And then the 70s came along, and we recognized that was all bunk. And so it's gone the opposite direction. In most economics, Marxists is silly. There are tons of Marxists out there, but no one pays them money. But what happened is we've kind of gone too far in the globalization thing for sure. And because of that, where the economics is still, that's what makes it great. It's because it's such a debate that's open to other ideas, unlike the other quote unquote sciences with climate scientists or history. If you go in there thinking Winston Churchill's a good guy, you'll never get a job in the academia, the ivory tower. There's another word I'm looking for, the great halls. I don't know. But anyway, you won't get a job because they all hate the West and they all hate Churchill. They all hate anything that represents colonialism, unless it's colonialism from Muhammad or something like that. But they all hate it if it comes from the West. It's nuts. Economists is different. It's open. That's why if you're going to school in a soft science, go to economics. It's freaking awesome. Anyway, I've always challenged the CAPM. And I didn't really know why it's challenged. I always said it doesn't make sense. The capital asset pricing model, we're assuming this based on that. And we don't, on any given day, where was your CAPM when the market was in 1998 or 1999 or 2000 or 1932 or September 1987? Where was your CAPM? Well, you didn't know. So why even assume any of this? Is crazy. Anyway, good stuff. Definitely get some books, read some books on economics, economic theory. The best book you can get, and I'll show you. Hold on a second. Free to Choose by Milton Friedman, of course, Milton and Rose Friedman. And this isn't my signed copy. I have a signed copy of a Milton Friedman book, Milton and Rose. And then, of course, Henry Hazlitt's Economics in One Lesson. I'll pause it to show you that. Would be Henry Hazlitt's Economics in One Lesson. I've probably ordered this book 10 times in my life. Economics in One Lesson, the shortest and surest way to understand basic economics. You definitely want to. This is an easy one to get. You can read or listen to in your car without having to really do a whole lot of research. That's great. That doesn't mean it's simple. It's easy to understand, but not because it's simple like for elementary school. But it's just common sense, man. It's common sense. So get these two books, and of course, if you buy them through my link, I get paid and I get make money. 4% on a commission on a $10 audiobook or a $13 Kindle book. I'm making bucks, man. So buy it through my link so I can get paid. Anyway, just get this book and my man Milton Friedman, Free to Choose. Can't go wrong. All right, we'll see you.